Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help people get better returns in the stock market. I am joined again by our regular host now, Robb Fahrion, the CEO of Flying V, Deep Knowledge Investing's marketing partner. Robb, thanks for doing this.
Thank you. I appreciate the bump in title. It sounds
Yeah.
like becoming a permanent fixture, which I'm excited about.
Yeah, hey, there's no one else I'd rather have doing this. And besides that, who else could I coordinate all these time zones with?
Yeah, it would be tough. This week was definitely
Oh
a
my God.
whirlwind. Obviously, we had Christmas Monday, and then we're one day off for everybody. So don't worry. Although I read something on Tuesday, it said I have no idea what day of the week it is, and I think everybody kind of felt that same way with the holiday falling on a Monday.
Yeah, that was definitely me between so Christmas Day was Monday, but I'm here in Asia, so I'm half a day ahead. I was in Thailand that day, flew to Manila, went to bed at 3 in the morning, Manila time, which would have still been Christmas Day on Monday for you. And now I'm in at Alona Beach in Bohol, Philippines. And I think we went from 15 hours apart to 16 hours apart. And yeah, there was a point where we weren't sure what day we were filming this.
Exactly.
Yeah.
Exactly. But we're all settled now. I'm back in Southern California. Gary again in the Philippines should be back here in a couple weeks. Today we got a great issue, the panic issue. Should we panic? How should we be responding to what's happening in the market? So, Gary, excited to jump into this. We're talking GDP, some stuff about Nike, FedEx, the Philly Fed. You ready to rock and roll?
Yeah, let's go. And by the way, I'm just going to put one thing in here first. We call it the panic issue, and we ask should we panic over this? Should we panic over this? And for a lot of asset gatherers, people who technically manage money for a living but don't do so with any skill, they'll panic over certain markets. Their clients will panic over certain markets. At Deep Knowledge Investing, we don't believe in good markets or bad markets. There's always something you can do. If the market's bad, we can short something. We can reduce exposure. We can own things like gold or Bitcoin that are outside the system or at least not correlated to the system. So our view at Deep Knowledge Investing is we don't panic. We just may need to find a different way to get the exposure we want. And that's what we do all day, every day. It's a lot better than panicking.
Great. That I'm sure settles everyone's ease at ease a little bit. So let's jump right into it. First point, third quarter GDP, as we've talked about on previous shows, was revised down from 5.2% to 4.9%.
Yeah. So, all right. First of all, GDP stands for gross domestic product. It is considered the measure of economic activity. What that 5.2% number said is that government officials think the economy in the third quarter grew by more than 5%. And you know what? That's a really big number, right? On its face, that's a big number. But there's some issues. Let's talk about those and why, maybe some people would be panicking over it. First of all, the government numbers are continually revised. Now, on one hand, I understand that, right? It's very hard for an economy the size of the United States to get all of the statistics, all of the numbers done on time. Of course, there are revisions, right? I mean, who hasn't done a first cut at work and then later gone back with a sharp pencil and then made sure that we understood things better? And that's pretty normal, but we are seeing a trend where the revisions are getting larger and larger and larger, and they tend to be in the wrong direction, right? So, the headline number will be 5.2%. Everyone likes that, more than 5%. But once they revise it down to 4.9, okay, there are a few other things going on. First of all, there's an inflation adjustment to that, right? So let me give you like the classic example, Rob. Let's say last year you went to the supermarket, you bought a loaf of bread for $1. Let's say this year you go to the supermarket, you buy the same loaf of bread for $1.05. Did we have a 5% increase in economic activity?
Right.
Right? No, you didn't, right? What we had was inflation. So there is an inflation adjustment to GDP, but our view at Deep Knowledge Investing is inflation is continually understated. And what that means is they're overstating GDP. They're counting some part of price increases as economic growth, right? Just like charging more for one loaf of bread doesn't mean that we have more than the loaf of bread. The second thing that's happening is an inventory adjustment. Sounds complicated. The truth is it's not. Inventory at retail, you'll have a certain amount of stuff on the shelves. And sometimes the shelves will be packed and sometimes they'll be more bare. But over time, that's going to net to zero. Over time, the shelves will have a certain amount of stuff. And so in this quarter, there was more added to the shelves, or in some quarters there's less added. And what that did was that added to GDP, but that's not a permanent addition, right? So what will happen is one quarter you'll be above, another quarter you'll be below. And if you really want to understand GDP, you back that out because, again, over time it equals zero. It's not real economic activity. Stocking the shelves is not producing things that people are buying. The final thing that's happening is we have a massive amount of government spending. And right or wrong, and I think it's wrong, government spending adds to GDP, whether it creates economic activity or not. So let's use the ridiculous example. Let's say the government says we're going to spend $10 trillion and we're going to grab 50 million people. We're going to pay 50 million people to dig holes. And then we're going to find another 50 million people and pay them to fill in the holes. And we're going to pay them $10 trillion. Now we have a roughly $30 trillion economy. So here's my question for you, Rob. In that scenario, did GDP go up by 1/3, by 33%?
Based on the way they're calculating, but in terms of economic growth, I like to call that a vanity metric.
Yes, that's exactly right. Right. So yeah, in that hypothetical example, GDP goes up a huge amount, but we haven't created value. And right now, Congress is overspending by about $2 trillion a year. This is on, a 27, $30 trillion economy. And oh my God, that's about, your 6-7% growth. And so if the government is buying this growth, then what does it mean for the real economy? And then, the key thing, some people might say, yeah, but that's real money in the economy. And my response is that's being added to debt. And it's not actual demand. It's not actual economic activity. What it really is future demand pulled forward. And as older people will get the bill, or your kids will get the bill, or your grandkids will get the bill, real economic growth is production and production that people want. And it's something that creates value, an investment in the future. What we're getting is tomorrow's consumption pulled forward today, and that doesn't necessarily create a whole lot of value. And so these numbers are faked, and a lot of them, you might consider them to be lies if you wanted to be impolite about it.
Right. Market on Thursday after the announcement was up pretty big. At the end of the closing takeaway, Gary, you mentioned that even with this revision, you don't think it's necessarily anything big or significant.
Yeah.
Anything to add to that before we move to point two?
No, I don't think it's a big deal. The reason the market was up is because with a smaller amount, with GDP growth being revised from 5.2 to 4.9%, the market was thinking, okay, great. Less economic growth means we're closer to a Federal Reserve pivot to lower rates. My view on it is between 4.9 and 5.2. They're both pretty big numbers. Congress is spending. The Fed is trying to slow the economy. They're at odds with each other. I don't think that revision really changes the calculation for the Federal Reserve or Jerome Powell at all. So the market moved on it. My view is no one panic over this. It's not as big a deal as people make it out to be.
Great. Point two, talking FedEx. FedEx lowered their guidance. FedEx missed pretty big with earnings. Turning it over to you, Gary, with point number two. FedEx lowers their guidance for the future.
Yeah, so the thing with FedEx, people like me like to follow the shipping companies because they tend to be a pretty good proxy for economic activity. Many years ago, I was traveling in Vietnam and I was on the Mekong River and I saw barges and barges going up the river loaded with bricks. Okay, so Rob, what does that mean? If you see a country moving millions of bricks, where there's only one thing they can do with those bricks, what is it?
Build.
That's right. That's right. That's real economic activity. Now, in the US, tracking shippers like FedEx or UPS, that's a similar kind of thing. right? Where we say, okay, when people are buying stuff, FedEx has to ship it. So it wasn't just that FedEx missed their earnings numbers, they took down revenue guidance. And that was FedEx's way of telling everybody, hey, yeah, we may have a problem in the future. We're not seeing a lot of demand for shipping. Now, there are a bunch of things going on here. One, some people will say Amazon has that business now. And in truth, Amazon, which used to use FedEx or UPS for almost everything, they've started to build their own fleet and do more of their own fulfillment, more of their own delivery. All right, that makes sense. The second thing, over the last couple of years, we've seen a shift from goods to services. People are buying fewer things and they're going to more concerts or sporting events or traveling more, right? I mean, that's what I do. I'm not buying so much stuff, but I'm out in the world having experiences. I understand this. But the other thing you mentioned Nike earlier, Rob. The issue is that even counting for some of these trends, the trend at FedEx is not good, and we're also seeing other corporate layoffs. And I think it was a day after FedEx announced their miss that we saw massive layoffs at Nike. So, there are issues here where the companies that have a really good window on the economy and the future economy are starting to signal signs of distress. They might say, hey, last quarter's growth was 5.2%, but we're expecting things to be worse in the future. And that's what we're looking for. We're looking for signals for the people who have to put money up. They have to put capital up and project the future, right? Because that costs them something. And let's take a step back, right? Let's look at the sell side analysts, right? From the big banks, they're all projecting huge increases in the market for next year. Okay, so what does it mean when the Wall Street analysts, and this doesn't cost them anything, are saying the market will be up big next year, earnings will be up big next year, but FedEx is saying we're not going to be delivering as many packages, and Nike is saying we don't need as many people, right? Those are expensive choices. And so right now we're pitting the Wall Street analysts who can just say things, they're right, they're wrong, who cares, against the people who have real capital at risk. In this situation, I would bet on the people who are putting capital up versus the people who are sitting in cushy offices saying, we think it'll be good, right? Because they're trying to sell securities, whereas Nike is trying to sell shoes.
Right. I believe it was about a month ago, I think we talked about, I believe it was shipping prices, if I
Yeah.
remember correctly, right? Any correlation there or anything that you were ahead of the ball on that could have signaled any of this guidance from FedEx?
Yeah, so that's a phenomenal question, Rob. And what's happened in the last week or two is shipping rates have soared. They've gone through the roof, but that's not actually related to economic activity. That's related to political activity and war. And the situation between Israel and the Palestinians. Some of the other countries have gotten involved and are sending drone attacks against shipping vessels that are going through some of the shipping lanes. And so, certain Red Sea shipping lanes are closed. It's not, a lot of oil companies are not moving product through the Suez Canal right now. And so if you take a look right now, and I believe, and I haven't checked this, somebody correct me in the comments if I'm wrong, I think the Panama Canal may be having problems with water levels. Again, I haven't checked that. If someone has more information on that, just stick it in the comments. We'd appreciate the help. But basically, there are a lot of things going on that are making it difficult to ship. And so we've seen shipping rates skyrocket over the last couple of weeks, but that's not economic activity, it's political activity or war war as political activity. We don't necessarily need to debate the definitions here.
Gotcha. Moving forward, we're talking Philly Fed. Diffusion index for current general activity declined from minus 5.9 in November to minus 10.5 in December. Philly Fed announces decline in new orders.
Yeah, so first of all, out of all the things we're talking about, I know I said at the beginning, don't panic, right? We don't panic. Out of all the things we're talking about, this is the one that concerns me the most. And let me just give you one statistic that we put in the written version of the 5 things. It's the index's 7th negative reading in the past 19 months, but here's the key point. The new order index fell from 1.3 to negative 25.6. Rob, that is a
Yeah,
massive,
huge.
that's a massive change. Okay. So, you know, when I'm saying, hey, don't panic, this one actually concerns me because that's a big change. Now, first of all, Philly isn't the whole country. The Philly Fed covers a region. That doesn't mean that things are bad in California or in the Midwest or in New York. But that's an extreme number. New orders going from 1.3 to negative 25.6. That's indicative of a real problem. Um, and so, you know, that one definitely concerns me. And, you know, what we've had here, and it's the same trend, right? We've had low unemployment, we've had wage gains. We actually had a really happy Christmas at retail. Consumers are spending a lot and keeping the economy afloat. Okay, all of that looks really good. But again, these orders are forward-looking. So we were talking about FedEx lowering future guidance. You know, we were talking about Nike laying off people. These are expensive things. The manufacturers in the Philadelphia area are cutting future orders. They're not putting capital to work. They're risking the possibility that there will be more demand than they'll be able to satisfy, and they'll leave profits on the table. Again, people with money on the table who are making investment decisions are saying we are so worried about what 2024 looks like that we're pulling in orders, we're spending less, we're firing people. This is a trend, right? It's a trend where we have a technically good economy today, but people are saying we are not going to invest for tomorrow. And that's, you know, that's indicative of a possible recession coming and is one of the reasons why we've been seeing lower fuel prices the last couple of months. You know, people are looking forward and starting to see that as well.
Great. Next point here, I'll let you kind of cue it up. We're always forward thinking, creative. DKI has a unique proposal to end inflation. So I'm very
Yes.
curious to hear more about this.
Yeah, so, you know, for everyone listening to this, let me ask you a question. How have you enjoyed our inflation for the last 2 years? Has it been fun paying more for things, right? Do you like seeing, you know, restaurant, you go to a restaurant and maybe the item that you used to order for $14 is now $20? You know, how do you guys feel? You go to the supermarket and you know, your $100 basket of groceries is now $130. Anyone who's had to buy a new house or sign a lease or buy a new car or a used car, you know, prices up 40%, right? Is anyone enjoying this inflation? Well, let's go back a few years. And Janet Yellen, the Secretary of the Treasury, pardon me, Secretary of the Treasury, she came out a few years ago and said her greatest regret was not creating more inflation. Okay, this is your government, people. These are people in charge of the largest, most important financial institutions in our government, and they're saying our biggest regret is not more inflation. So if you're watching this, right, raise your hand. Are you enjoying this inflation because it was intentional, right? Janet Yellen and our government intentionally did this. They did this to us. They did this to you. They did it to me. This was not an accident, right? To have your Treasury Secretary say, my biggest regret is we don't have more inflation. Well, guess what? We have it now. Is anyone enjoying this? I'm not. Are you enjoying it, Rob?
Definitely not.
Right. So I was walking around Manila, and if for anyone who takes a look on the Deep Knowledge Investing website, we have the written version of the 5 things. I have a picture outside the Manila SaveMore. It's their supermarket, and it actually says chicken price watch. December 1st, 160 Philippine pesos to the kilogram. I'm going to do the math for you guys. It's about $1.50 a pound. It's a pretty good price, right? I come back 3 weeks later, I have a picture next to it, the chicken price watch. By the way, I love that name. Like, why don't we have a chicken price watch? This should be added. Why is Jerome Powell not announcing once a month the chicken price watch index, right? Powell should, listen, if these people aren't going to take inflation seriously, if they're not going to take our currency seriously, we need a chicken price watch. Okay, so I walk by December 20th, the Manila SaveMore, and the price for chicken, 160 Philippine pesos a pound. The Philippine Manila SaveMore manager has defeated inflation, right?
Impressive.
Right? It is. It is. First of all, good for him. And good for the Manila SaveMore putting that important price for the Philippine diet out in front of everyone. They're advertising it, right? They're advertising it is a stable price. So my modest proposal is we make a trade. We send Janet Yellen to the Philippines in exchange for the Manila SaveMore manager, right? Let's just get a Manila grocery store manager. We put that guy, maybe a woman, I don't know, I have no idea who's running the place. We put that person
Whoever it may be.
in charge of the US Treasury. And let's just see how it goes, because here's my question. Is it going to be worse? Can the Manila SaveMore manager do a worse job for us than Janet Yellen, who tried to and successfully helped create inflation? Now somebody has suggested that, the Filipinos might not be happy with that. They might be angry losing their beloved SaveMore manager who's defeated inflation and getting Janet Yellen in exchange. Okay,
Yeah.
I get it. I get it. I am willing to chip in. Deep knowledge investing readers, Rob, I'm going to ask you to chip in. Philippines, we will throw in a case of chicken with Janet Yellen.
Yes.
It'll be like a baseball trade, right?
Yep.
It'll be like a
Yep.
baseball. We'll send you Janet Yellen, Treasurer of the Secretary. Why can't I say this? Secretary of the Treasury, and a case of chicken. You send us the Manila SaveMore manager. Would you go for this, Rob?
Yeah, I'll take Janet to the airport right now. That's perfectly fine.
Free trip to the airport. Wait,
Yes.
and once I'm back, I volunteer to drive to the airport. Manila SaveMore manager, I will pick you up.
Oh, first class service,
Yeah.
no doubt about it. Reminds me too, it's been floating around on X, the Kevin McAllister Home Alone. When he heads to the grocery
Yeah.
store, he purchases, what was it, $20-$30 worth of groceries.
Yeah.
2022, they showed that same grocery list. I think it was $48. So of course you've got 20 something years. And in 2023, that $48 list was now $72, I think it was,
Right.
over the course of just 1 year.
Yeah, exactly. We don't need Janet Yellen. We don't need Jerome Powell. We definitely don't need anybody in the US Congress. Somebody send us the Manila SaveMore supermarket manager. And if it's not that manager, just get us the chicken guy, right?
Yeah,
Put the chicken guy in front of the US Treasury, and honestly, what's the worst that can happen? It has to get better.
I think we need to draft up the formal proposal right after this call. So we'll get going on that, DKI listeners.
Right. Yeah. And if, again, for the people watching, if you're willing to contribute to the case of chicken, just, put that in the comments, and don't worry, it's not really a binding thing.
Love it. Oh, that's great. All right. Moving to our fifth and final point for this week. Personal Consumption Expenditures Price Index, PCE, is up less than expected. It falls versus prior month.
Yeah. So let's cut to the key point on this. One of the things that I've been making fun of, one of the things I've been very critical of over the last year, is people keep talking about lower inflation. The Fed is beating inflation, right? And that is 100% not true. It is weapons grade baloney. What we've had is disinflation. Okay, that's a fancy word for a change in the rate of inflation. Now, for those of you who did not love your high school calculus, right, a change in the rate of change, your second derivative, let's simplify it. Let's say you have inflation of 10%. So your grocery basket goes from $100 to $110. And then you have inflation of 5%. So, you go to a little more than $115, and they say, terrific, we have disinflation. Prices are getting lower. No, prices are not getting lower. They went up $10, and then they went up another $5. And yes, there's compounding, but we're trying to keep the example simple. Don't bother, correcting the math in the comments. Sometimes it's easier just to give people the easy version right now. So we're rounding some of this. But if your grocery bill goes from 100 to 110 to 115, and people tell you, hey, Rob, isn't this great? Prices are down. No, prices are not down. They just went up by less than the year before. So the PCE is the Personal Consumption Expenditures Price Index. That's the one that the Federal Reserve really looks at, right? We all look at the CPI, the Consumer Price Index. That's the one that people use to estimate inflation, and that's the one we focus on. But the Fed really likes the PCE. And so cutting to the end, the big deal was the November PCE, was up 2.6% versus last year. Okay, so it's a little high, but it was down 0.1% from last month. And so for the first time in a couple of years, we actually have a reduction in price levels. Now, is 0.1% a big deal? No, it's not. But actually, over the last 6 months, we have had price increases that total an annualized rate of less than 2%. And people are saying, okay, wait, hold on a minute. We've had 6 months of price growth that's less than the 2% Fed target. And we just had a month of declining prices. And for the people who are saying, hey, wait a minute, like this is the end, we've reached the terminal rate, which is the fancy way of saying the highest rate of Federal Reserve rate hikes for this cycle, and we're coming close to the pivot. This is your example A, right? This is your example one, because we actually did just have a change. And, I'm not the only person who suspects this, but I believe, Jerome Powell probably had some insight on this when he gave that very, very dovish press conference a couple of weeks ago and indicated to people, yeah, we're really done hiking this cycle. So for those of you who have been waiting for the Fed pivot, a couple weeks ago, Powell got in front of the cameras and basically said, we are done hiking. He didn't say it that way, but that was the message, and I agree with that. We've now seen a negative PCE for the last month. We've spent 2 years saying higher for longer. It is, again, time to stop saying that. The next move by the Fed is going to be a rate decrease.
Great. Thanks so much, Gary, as always, for your contributions. This week's 5 things. Any closing thoughts to kind of wrap up our panic issue? And as I do always like what you say, no matter what type of market we're in, good, bad, indifferent, there's ways to make money, and you do a great job of really conveying that to our listeners. Anything to close with?
Yeah, thanks, Rob. Oh, first of all, thanks so much for doing this. I always love our chats. For everyone, one of these days, we're going to start filming our talks before and after we film these, because Rob and I just hang out talking about business, finance. We have a great time. For everyone who's listened to this, thanks so much for your time this year. It's valuable, and we appreciate it. And, we put a lot of time and work and effort into getting the analysis right on this. And the reason we do it is because you guys deserve that, and because your time is valuable, and thank you for that. I am going to take a little time at the beach here in the Philippines and relax a bit, so there won't be a 5 things for the next week or two, but we will be back in mid-January, ready to go strong and smart. In the meantime, nobody panic. If you're concerned about, the way your portfolio looks going into 2024, reach out. We may be able to help you. That is what we do all the time. And for everyone else, we hope last week you had a Merry Christmas, a couple weeks before, a Happy Hanukkah. Wishing everybody a Happy New Year in a couple of days. And Rob, just want to express my appreciation to you and Flying V. Always great doing this with you.
Yeah, appreciate that, Gary. And as you're saying that, I realize, the next time we speak will be after the New Year. So to everybody out there, hope you have a safe, happy New Year's. 2024, we're really excited about, especially everything DKI related. Gary, I know you and I have been working quite a bit to build more value, better resources, better communications for all DKI subscribers. So we're really excited for what we're rolling out here at the beginning of the new year. And we hope to continue to create good content and information. As always, if there's any feedback or things you'd like to see or hear about, please don't hesitate. Leave us a comment, contact us through the website. And if you're just hearing about us, be sure to subscribe to the newsletter. There's a free version for you to at least feel us out, see what type of information Gary's putting out there and his team. And really, as you mentioned, Gary, and to echo you, thank you to all of the DKI subscribers. It means the world to us. You really are the lifeblood of this organization. And thank you all so much for your support. Gary, I'll give you the last word.
Happy New Year to everyone. And, let's get ready for hopefully a prosperous 2024 and try to make a lot of money in the markets. That's what we're going to be aiming for. And looking forward to seeing everyone next year. Thanks.